Good afternoon, good morning, depending on from where on earth you are logging in from. So welcome back to the new era of agriculture commodity trade. Welcome to session 2, day 2 of Commodity Week World 2026 or CWW26. Just a visual and a mic check. Neeraj, am I audible and visible?
Yes, sir, loud and clear.
Perfect. So early today, we kicked off day 2 by dissecting the massive production and consumption pivots in Asia and Pacific wheat corridor. Now we are chasing the sun westward to focus on a region where two fundamental pillars of human calorific survival, the wheat and rice, intersect with intense geopolitical risk, currency volatility, and shifting trade flows. Welcome to the Europe, Middle East, and Africa War Room. We have declared throughout this marathon that the agriculture value chain has crossed a critical threshold. The traditional book, the one that relied on predictable crop cycles, stable trade corridors, and reliable trade alliances, has officially expired. We are observing cyclic movement corrections no longer exist. We are operating within a baseline of permanent and structural volatility. Over the next 5 days, we are continuing to bring the global boardroom directly to your screen. CWW26, organized by HnyB Tech Incubations and Know Your Commodity, is presented by AgriGuru Online and is supported by Crypco Agri, Bergeron Group International, and Bengani Group, along with our association partners, OATA Myanmar, Ukraine Pulses and Soybean Association, and GOPKI Indonesia. Other institutional partners include Solidaridad and World Cooperation Economic Forum. CWW26 is moving entirely beyond the delayed data of historic balance sheets and presentation. This is an unscripted, unfiltered war room. We are here to democratize the high-stake market intelligence, mitigating the systemic risk of information asymmetry. The foresight needed to defend your margins and ensure equity for producers and consumers alike is all here. As a reminder, our sessions are beamed live across multiple digital assets on multiple LinkedIn handles, YouTube, Twitter or X, Facebook, and our event website. You can find the links in the comments. Let's talk about the macro view. While the maize drives animal feed and food and fuel, the oilseed powers the energy transition, while wheat and rice represent the absolute baseline of global food security. They are ultimate political sensitive commodities where a single export restriction, border closure, or drought can trigger acute food inflation overnight across entire continent. Globally, the grain balance sheet are tightening significantly. Let's look at the baseline numbers. For 2026-27 marketing year, the global wheat production is forecasted between 815 to 821 million metric tons. This represents a sizable drop of close to 23 to 28 million metric tons compared to the previous season. Meanwhile, the global consumption is outpacing the production, tracking upward to 825 million metric tons. This negative supply-demand delta is leading to restricted international trade and sharp contraction in global carryover wheat stocks, which has tightened down to slightly vulnerable 280 to 284 million metric tons. Simultaneously, global rice balance sheet is also on razor edge. Global rice production is struggling to outpace a surging baseline of global consumption, which is tracking at record high of over 525 million metric tons. Global ending stock for rice are projected to drop to their lowest level in 6 cycle, down to nearly 165 million metric tons, out of which close to one-third is in India. With major exporting hubs in Asia maintaining calibrated export regimes and tariff walls, the buffer stock available to non-producing countries have become incredibly thin. When lower production hits major exporting origins, simultaneously, import-dependent regions face immediate procurement anxiety. To understand how these global tightening trends translate into physical trade risk, we must look directly at the ultimate destination crucible, which brings us directly to our second panel today, the Europe, Middle East, and Africa theater, where geopolitics, currency squeeze, and logistic choke points are the norm. Here in Europe, the Middle East, and Africa, the wheat and rice narratives are defined by structural import dependency and extreme execution frictions. The region does not just buy grain, its stability depends entirely on seamless execution of maritime logistics as well. Let's break down the critical EMEA pressure points. First, the Black Sea pipeline. The EMEA wheat matrix is fundamentally anchored by Black Sea corridor. Russia and Ukraine remain the dominant supply engines for the entire Mediterranean and North African basin. However, with the tightening global export surplus and local production costs scaling up, the pricing matrix has become incredibly volatile. Compounding this is Europe's internal balance sheet. High input costs, shifting environment regulation, and adverse weather are restricting EU's wheat yields, turning Europe into a competitive marketplace for nearby suppliers. Second, the North African and Mid Eastern demand crucible is also having nations which are some of the largest importers, Egypt, Algeria, Saudi Arabia. They are amongst the top importers in the world, while also pulling in a massive volume of long grain and parboiled rice as well. Buyers in this corridor are currently facing a dual crisis, tightening global balance sheet on one side and severe macroeconomic headwinds on the other. They are navigating localized currency devaluation, acute dollar shortages, and persistent threat of maritime disruption, which skyrocketed the freight spreads and war risk insurance premium. For procurement executives in Cairo or Algiers, the challenge is no longer just predicting the flat price of the Chicago or Paris exchange. It is also securing the physical execution parity. The third, which is sub-Saharan African, the rice crisis is imminent there. The transitioning from a discretionary luxury to a primary daily calorie staple, rice is creating more challenges than solution today. While many of the African nations are looking for self-sustenance in rice, but easier said than done, that push is not leading where the import numbers are going down. West and East African nations are increasingly reliant on international trade pipelines to fill a structural deficit of millions of tons. Buyers here are completely exposed to the policy choices of Asian exporters and are forced to continually arbitrage alternative origins, balancing price, quality, strict trade financing constraints, just to prevent acute food security shocks in the domestic market. Now, the day of relying on lagging monthly reports to make multi-million-dollar procurement decisions are over. Navigating this extreme volatility requires elite ground-level foresight. We are going to extract that foresight right now. We have assembled an allied strike force of EMEA wheat and rice expert. We have the originators who manage volatile cross-border physical flows across Mediterranean. We have analysts who decide shifting trade finances and production parities. And we have the commercial leaders who are forced to execute large-scale procurement amid the chaos. Our session remains the same. No scripts, no filter, pure intelligence. Welcome to the session 2, day 2 of Commodity Week World 2026. Let's officially open the wheat and rice, Europe, Middle East, and African war room. With that, I would like to invite my first speaker, Mr. Hisham Suleiman. He is a premier grain industry authority serving as a president of Mediterranean Star for Trading, a leading wheat and flour enterprise in Egypt. With over 2 decades of commercial experience, he is an expert on EMEA region in import mechanism, milling economics, and Black Sea origin dynamics. He is frequently consulted by government bodies for his analysis of current challenges, import regulation, and logistic infrastructure, making him a central figure in Mediterranean agri-trade. Over to you, sir. Pleasure to have you. Thanks for joining us.
Thank you, and good day, everyone. It's my pleasure to be with you. It's a real pleasure. I'm introducing myself. I'm from Egypt. I have been in the grain market since 25 years, not only in Egypt, but North Africa, MENA region, and many countries like North Africa, South Africa, and so on. So today I would like to share with you my thoughts and my presentation about the wheat situation after the geopolitical risks. And I will not stop long with the geopolitical risks, as everyone now is full aware with everything here. But let's focus on the results. The war started, and then everything collapsed, everything goes upside down, and no one knows when it will end. But let's compare pre the war and after, in the middle of the war, and after everything is calmed down after the ceasing of the fire. All of us is full aware with the whole street disruption and
Sir,
what
you'll have to
happened.
you have to share your presentation. It's not visible. I think you'll have to share it again. It got disconnected, it seems.
Let me hold here.
The same process you have to go again.
I see. So let me do it again. Sorry for this technical issue, but it's not able to be shared here. Okay, hold on for a second.
Yeah, we can see your screen, sir. You have to just go to presentation now.
Okay. Is it visible now or?
Yeah, it is visible. You have to just do the full screen, which is on the right-hand corner.
Okay, I will do it right now.
Perfect,
Okay.
sir. We are already into Strait of Hormuz, it seems.
Okay. Okay, great. Thank you. And sorry for this
No,
technical.
no issues. No issues, sir.
Anyway,
Please.
back to the presentation. The Hormuz Strait disruption makes a very dramatic issue in the trading market. I will try to be fast, not to waste the audience time, and just to be focused on the most important points. Okay. Uh, the war and the disruption in the Hormuz Strait not only was because of gas and crude oil surge in the prices and so on, but it was beyond this. It's not only the gas who affected the freight rates as well as the insurance and the shipping routes changed after the Hormuz was closed, and the procurement strategic places changed and the route changed. Everything went up with no expectation from anyone. And the most important for the traders is the commodity itself. We're not talking about only freight, only insurance, or shipping routes, or crude oil. The crude oil prices, it went high. The barrel per went up more than 100. I know that after the ceasefire yesterday, price was $93 per barrel for Brent. But it's still we are suffering, although that they are ceasing fire and everyone is expecting the agreement between USA and Iran, but the market still monitor what will happen. For Egypt, I'm not because of Egypt. I'll take Egypt as example because we are talking about country who's importing 3 to 14 million tons of wheat yearly, and its share about 5.6% from the total wheat trading all over the world. So, what will happen with us in the prices pre-war and after war? In February, end of February, the Russian wheat was around $252 CIF Egypt. Okay. In the middle of the war, we hit 270 and 267. It's a dramatic, like you have almost $18, $16 to $18 increase in a commodity price. But now, after ceasing fire, prices went down to 260 to 62. The same for the prices. It's on my screen right now to show just only, it's not only the gas and the oil and the freight, but the commodity itself, it changed and the prices went up dramatically, which affect every country in North Africa. Okay. But this not only the only effect, because if we are going to talk deeply about the global wheat outlook, top exporters and top importers, we will see here number one in exporters is Russia. They share in the wheat export. For an example, we are talking about 219 million tons of exports of wheat all over the world. Just to be sharing the numbers with you to show how is the share of each country. Russia is number one with 17.7% sharing. Then USA and Canada are the same, 14.1% of the total export of wheat. And then we have France with 10.1%. Okay. And finally, Ukraine with 8% of export. These are the 5 top exporters of wheat recently. Then what about the wheat importers? Egypt will become number one with 5.6% of the total wheat imports, we're talking about huge amounts, 13 to 14 million tons per year, with equal to $2.7 billion. And number two is Indonesia, with 5.5% from the total imports, with $2.6 billion value. And then we have Turkey in number three, with 4.9, and so on to the rest, or till Algeria. These are the big players, exporters and the importers. And let's focus on one issue also, that the total grain production this year is 2014.4 billion ton. We have out of it 820 million ton of wheat. This is the total production. While if we're talking about the total consumption, we're talking about 824 million ton. So we have shortage around 4 million ton. And this production this year is less than last year with 3%. So it's a quick snapshot on the wheat outlook. And then we will move on the currency. The currency, this is also one of the effects, big effects, was a result of the war. And if we're talking about Egypt, before the war, $1 was equal 47.25 piastre before the war. And in the middle of the war, we kicked and we reached 55 pounds per $1. Now, after ceasing the fire and everything started to calm down, the price went down a little bit to 52.5. But although that the price of the dollars went up, the price of the commodity went up. But what happened? Most of the governments are right now is afraid if this war will complete, if it's going to be expanded and other countries will be involved on it, it's going to finish. Although that Egypt in the middle of harvesting of the local crop, and for example, till yesterday, the government collected from the local farmer 4.3 million tons of local crop, which is a very good number. We didn't achieve it before. In the last 3 years, the maximum was by end of the harvest, which will finish in middle of August. We didn't manage last year even to hit 4 million, but now we are 4.3 million ton, which is good. And I expect that it will head to 5 million tons this year, which is the target of the government to collect from local farmers. But although with these good results of the crop and the big numbers we are collecting from farmers, Egypt started to buy big quantities, although that we have a good crop, just because it's not only trading issue, it's become a security for food issue. For example, last year, if we are going to compare the first 5 months in 2025 to the same period at 2026, we're talking about 60% increase in imports for Egypt, although the crop is very good. Total imports of wheat in the first 5 months of the year, we achieved more than 7.3 million tons of wheat. Because of what? Because everyone is afraid. What if? Numbers are increased with 60% compared with last year. Prices this year is very expensive than last year. But I have to remember the traders that in 3 years ago, we were buying the wheat with $350. So it's no matter how much is the wheat. The governments in everywhere will have, her rule is to secure the food for the people. So regardless the price, it's as we mentioned, it's a national food security problems. They have to work and solve it without waiting or delaying in buying. So everyone was buying very dramatically and aggressively, despite the prices are high, despite the logistics is not easy. but they have to secure the food for their people. So all governments are moved. Let's take some example in North Africa and Asia. We have, as we see in last tender in Saudi Arabia, they put almost near the million ton. It's 982 K. And we have Jordan and Algeria is keeping going in and out in the market. But we have to mention something. It's we got used I'm talking about from my point of view, in last years of experience I had, we were studying the market by supply, demand, the crop, the weather, the climate, and so on. But now it's not the same. Procurement have been changed. It's not the old way, because now everyone is trading in wheat, corn, whatsoever commodity he is trading for. He has to take in his consideration the geopolitical problems, because it's coming out of the blues. No one can expect it. But for Iran and war, we were expecting it 1 month before, because it was hit and run between the three countries. But anyway, every trader has now to put his plan for plan A and plan B and plan C. He has to find many origins just in case something happened in any of the regular countries they are working with. He has to find another source of getting his cargo, because nothing guarantee in these days, as we all see that the war start like this. Let's in one day, everything went up without any expectation to reach this level of prices. Then, what is the projection for the traders of this year? Market is still under pressure, although that they ceased the fire and everything is calmed down, but at least everyone is monitoring what's going on, and if the problem will remain or it will be solved amicably, and then the Hormuz Strait will be open in full. Number two, what will be the duration to the market to go back to normal? How long it takes if things solved and everything went okay? We talked about the grain production of wheat, and the most important issue, which is most of traders didn't take it in consideration, is the fertilizers. And then we have to stop here, because this commodity has a big effect on the production. And I guess one of the results of the Hormuz Strait closure, as well as the war, that in crop 26-27, we will face a big problem because of the fertilizers. First of all, the price of fertilizers went up dramatically. For example, prices are between 800 to 900 FOB. It's doubled and tripled than normal. And for whom he is not following this, let's talk about that 20% out of ammonia and urea is going out from Gulf area. So after the closure of the strait, Hormuz Strait, it's not anymore available. Plus, the expectation are saying that there is 1 million ton of sulfur are stacking there. And for people who are not aware with sulfur is using to clean oil and gas and use for agriculture. 1 million ton is not a small quantity. This is push even the Qatar company who worked in fertilizer to announce that the price for sulfur FOB is $800. So I expect problems in the yield of most of the country because of the fertilizers. And my expectation also that the prices for the commodity for the crop 26-27 will be a little bit expensive, because without fertilizers, you cannot get a good yield, a good crop. So if you add the cost of fertilizers to the agriculture, then the calculation will be different. So I don't will expect that the prices next year will be down unless it's the price of fertilizer eases at least to 300-400 as normal as before. But if it remains for a long time like this, I guess all the prices for all commodities, not only wheat, will be a little bit damaged by fertilizer prices, and then we will see a high prices in next year. And the last issue, it will be the ending stock. Due to this war, I expect to, as we mentioned, the big exporters for wheat, the 5 big countries. My expectation that the ending stock this year will be high at these countries due to the logistics problems, as well as that the lack of demand, because everyone now is waiting. Is the right time to buy? What if the war finished, then the prices will collapse? So everyone is a little bit cautious before taking the decision of buying. Although that we have a problem now in Russia, which is number one exporter, it's the delay in harvest. And this is will not affect the market because you will have a big ending stock, so that we can feed still the market. But I don't expect to see any of the new crop Russian shipment to arrive to Egypt or Middle East before August. Thank you very much. I tried to be very fast, just not getting boring to anyone. Okay, thank you.
Perfect. Perfect, Mr. Hashim. It was a very structured presentation. You took us to all key challenges and points in MENA. Just a small question. As a trader, do you see that actually like it is time to go long? Because you said that there are expectation of high prices. Is it a time where you should buy whatever you get?
Actually, to be honest, it's a very hard decision to any traders to decide to go long or short, because the fundamentals we are having now in our hand to take a decision to buy short or long is not clear. So if you go long, okay, and then what if the war finished and the freight went down? So you will achieve, if you are not a risk taker, and you shortening yourself when based on the prices will go down, and then the war extended, then you will be also in a very bad situation. So I guess it's not right for now to go long or short without seeing what will happen. A lot of changes in the market, which prevent that you take a decision like this. The risk is high.
Perfect.
So everyone has to slow down in his procurement till the picture get more clearer.
Right. So deploy your traders who are 50 plus, not the young one, so they don't take too much of risk. Thanks, Mr. Hisham. It was a pleasure to have you as a speaker. And now we would like to go to our next eminent speaker, Mr. Mark Oswald. He's a legend in his field, and it's always a pleasure and an honor to be sharing screen with him. Mr. Oswald is a world-renowned global strategist and chief economist at ADM Investor Services International in London. With a storied career spanning several decades, he specializes in macroeconomics, global monetary policies, and structural drivers of inflation within the international commodity market. He is an authoritative voice on evaluating the complex cross-current between energy costs, geopolitical risk, and agriculture market fundamentals, providing deep market foresight to institutional traders and global corporate executive worldwide. Thanks a lot, Mark. It is always an honor and a pleasure to have you, sir.
Hi, very great pleasure to join you.
Perfect. So the first question, the most difficult one to start with, according to you, how are the complex cross currents between global monetary policy, energy cost, West Asian crisis are actively dictating the structural inflation in the agriculture sector in general?
It's a very, very difficult situation, this one. There are, for a lot of people, there are a lot of cross currents between what we saw and in 2022 and now. I think it's important to make one big distinction. In 2022, on the Russian invasion of Ukraine, it was very concentrated and it was very immediate. The big difference now is this is much more dissipated, it's much more global, and the impact is cumulative. By that I mean, with each passing day of disruptions to supplies, as Hesham said in the previous slot, it's not knowing when it's going to end, and it's also knowing that the cumulative disruption is perhaps going to be the biggest driver of inflation. Now, energy prices are essentially driving pretty much everything. The dollar's dancing to the tune of energy prices. Higher oil prices means higher dollar, lower oil prices, lower dollar. And the agricultural complex is also pretty much dancing to that tune for obvious reasons. Transport costs are, and basically the basic costs of things like diesel are absolutely a key component. Then on the other side, you have central banks. Now, central banks basically back in 2022, 23, completely misjudged the pass-through from energy and food price costs through to more general inflation. They misjudged that because at that point in time, we were just in the post-COVID era and there was a lot of pent-up demand. So it didn't prove to be transitory. They were behind the curve. This time around, we're actually in a very different situation. There are very disparate trends in economies. On the one hand, there's the AI investment boom, which makes the growth numbers globally look good. On the other hand, if one looks at the lower end of the scale, the cost of living pressures, the legacy ones from 2022, are still there. So we're now getting a double whammy, if one wants to call it. And as we've seen when one looks at, say, PMIs in Asia, in Europe, to a certain extent in the US, though it's a slightly different picture, the ability of retailers, of wholesalers, of producers to pass through these the rising costs that they've got, which isn't limited just to energy, to end users, is actually proving to be quite difficult. So in that situation, central banks then have this really difficult choice to make. Do they, because they are chastened by the experience of 2022, act proactively and raise interest rates, only adding to pressures which are already there? Or do they take some time to try and see what the differences are this time around between the pass-through pressures that were there then and the pass-through pressures that are there now? So it's an incredibly complex interface, and it's made all the more difficult because of that AI investment boom. We have some generalized inflation pressures on all raw materials. And this is where, as Hesham was talking about, things like nitrogen, sulfuric acid, and indeed for the technology sector, helium, which are key for producing technology, all the high-end technology that we have, and indeed a lot of the defense equipment on which there's a lot of increased spending, how that all feeds through into what's the best judgment on what they need to do to head off this inflation. And you're already seeing in emerging market economies, which are big importers of energy or food or both, such as the Philippines, such as Indonesia, Pakistan, they are being forced, those central banks are being forced into quite dramatic rate hikes, 50, 100 basis points just to start with. Whereas the developed world ones can, to a certain extent, hope that they can rely on governments to try and introduce some subsidies, tax cuts, whether it's value-added tax or goods and services sales taxes. But it is so difficult to make a judgment when you don't know actually when this war is going to end, and that is where the trickiest part lies. For some central banks, such as the Federal Reserve in the United States, which obviously is going to be critical for the performance of the dollar, it is, they have the market doing a lot of work for them. So to a certain extent, they can sit back because they know that the market has effectively already tightened financial conditions by the rise in long-term bond yields. But for others, it's far more tricky. For instance, in Japan, where the Bank of Japan is behind the curve. And for the ECB, the biggest challenge is they know that underlying growth in Europe, and this also applies to the UK, is weak. And they are not getting the sort of benefit from the AI investment boom that, say, Asia or the US is. So it's a very, very tricky situation.
Couldn't agree more with you, Mark. The challenges are there. But at the same time, when we see these numbers, right, do you see that they are just temporary numbers or inflation pressure, or it might eventually become structural in nature, putting such type of risk premium, right, within all the commodities by default going forward? Do you think that could be a possibility?
I think it's a distinct possibility, and that's why I was mentioning about the AI investment boom. We have a world which has moved in general, as Hisham was talking about just in case. We were operating pre-COVID in a just-in-time management system. We are now definitely in a just-in-case. Everyone is primarily concerned about security of supply, be that of energy, be that of agricultural products, be that of raw materials and minerals and metals. And that creates a further challenge for central banks, particularly the very short-term one. Because at the moment, what we're seeing in manufacturing is a very big buildup of inventories because people want to make sure that they have done their just-in-case purchasing. That once they've got the sort of stocks and secured, the lines of inventory that they want, could suddenly tail away. So we could get we could still be in a situation where the situation in Iran is not resolved, but suddenly we see prices falling because people have actually already stocked up enough. How do you make a judgment call on that in the long run in terms of monetary policy? Very difficult. But then you have to also weigh that against this AI investment boom, the energy transition, which basically puts underlying structural pressure on prices. We've lived in a world since the end of the Cold War in 1990, where basically it was a world of plenty, a globalized world where you could basically look around, shop around, look for the best prices, and get what you want. Now we have all sorts of issues. For most people, I think the idea of the Strait of Hormuz being closed was an idea, well, it was one of those things which we should never indulge in. Well, that just wouldn't happen. Well, this happened. And now we're going to have to live with the consequences. And we're also going to have to live with the consequences of a lot of people, particularly in the emerging world. The countries and Japan and South Korea, which are big importers, net importers of a lot of raw materials in the agricultural sector and in the energy sector, that they have to realign their strategies. They've suddenly realized we've got a single point of failure here within our supply chain. How are we going to adjust to that? So the assumption that say we got a complete reopening of the Strait of Hormuz, that things would revert to pre-February 27th trade flows is, I mean, that's basically out the window because everyone basically needs to rethink where they are. But the underlying pressure from needing to secure supplies of everything that you can possibly think of and to have a much stronger national, as China has done. China is our template here. China has basically seen the least impact thus far, but it's not immune in the situation because it was basically looking at the situation with the new Trump administration and seeing the possibility that these sort of disruptions can happen. So, beyond the already high levels of inventories that they were running, they decided, let's double down. Let's make sure we don't actually suffer, that we can sit what may be a protracted conflict out. A lot of countries are now going, particularly the more populous countries. Hisham made this good point. At the end of the day, for a lot of governments, ensuring the supply of agricultural goods to feed people is their primary objective, and trying to keep them at prices which are tolerable, shall we say. And that's really a big challenge now. If you've got a structural inflation for a lot of countries which don't have a lot of fiscal headroom, particularly in the emerging world, this is going to be inordinately, this is the biggest challenge over the next 5 years, how to restructure their purchasing and also how to manage it in the short term, because the two things need to run in parallel, i.e. changing your long-term strategy. But in the short term, you also need to make sure that you're not going to, get food riots and social unrest.
Perfect. So, Mark, the next question, you rightly touched upon that, many of the emerging countries would be having the challenges because they might not be having headrooms and they have to play with their interest rate to ensure that the inflationary pressures are not too much. But at the same time, the countries are also suffering because the volume of debt which we are seeing today have never existed. So now the debt can also lead to a possibility where the purchasing power of these countries cannot be gained and they might rely on, I would say, philanthropy rather than actually their own capability. Do you see that also happening going forward?
Yes, I think it's a big challenge for everybody. And one should remember in this situation that the developed world countries are also not in a good fiscal position. They have a lot of challenges. So rising interest rates, particularly rising long-term rates, are a big challenge. They've got adverse demographics to deal with rising costs of social care. So somewhere along the line, we are going to get a lot of shifts here. But the challenge for the emerging countries is one to remember something that we've seen as a trend over the last 15 to 18 months as a result of the US tariff wars. And this is a very important point. People need to realize that actually the global south, the non-aligned countries, whatever you call them, i.e. not Europe, not North America, not Japan, actually have a lot greater capability to trade with each other. And, that is for a lot of those countries actually starting to become a big boon. So that is one strategy which they need to focus on developing to try and develop much greater ties than the traditional ones, where everyone seems to be always focused on, well, what can we sell to Europe? What can we sell to North America? That's, if you look at it in population terms, that's actually almost ridiculous, because Europe and North America account for just 850 million people in an 8.5 billion population world. The rest of the world should be trading much, much more with each other and actually saying, you know what, if we get business with the US, or if we lose business with the US because the whole the barriers from tariffs, or indeed Europe with tariffs, and indeed Europe's very top-heavy regulation, so what? We can trade with each other, and this is, I think, going to be the biggest thing going forward. But in the short term, dealing with the fact that they actually can't put in subsidies in a lot of cases because their fiscal ability is not there to do it is, it's going to be immensely challenging. And the developed world actually needs to think about what they do in terms of subsidies, because just because they can secure those supplies, they need to also think about the spillover effects into the emerging world, particularly when most of those countries have there is a lot of populism around and complaining about immigration. But if you cut off and make the supply of things like food, above all, more difficult for those emerging countries, then you're going to see an ever bigger flow of immigrants into your country. And that is actually going to lead to a social unrest there. So the real problem here is we live in a world where the political alliances are fracturing just at the point in time where actually we really need the whole of the world to start pulling together to meet these challenges, and that is the biggest challenge of the moment. Sadly, when I look at the political leadership, particularly in the developed world, I don't see too much encouraging signs in terms of real statesmen who look beyond the political cycle, i.e., the 5-year or 4-year terms that you have for governments, in terms of the way that they act. But this is the moment, because we all need to be addressing this. And if there was a lot more working together and collaboration, then we could actually solve a lot of these problems, particularly given the technology boom, because the technology boom will solve a lot of these problems.
Perfect. I couldn't agree more with you, Mark. One thing is that not so rich nations need to start thinking about serving each other rather than just serving the few rich nations. That's very important. And secondly, on the leadership, I couldn't agree more with you. Like, we are having currently, we need the best of the leadership, but we are having the most disappointing leadership ever seen by human race so far. We have seen World War I, II, which were far worse than what we are seeing today. But still, we had hope because the leadership was there who were actually ready to take the hit. Even some of them, they lost their elections and their positions because they took right decisions. I don't think that courage is there in current leader. Unfortunate, but that's the reality of the life. Thanks a lot, Mark. It's always an honor, a pleasure to be talking to you, sir.
Thank you. Thank you.
So with that, we move to our next speaker, and we are having in-house Cesar Soares. He's a distinguished commodity strategic advisor with extensive international experience, specializing in the EMEA and Americas agriculture market. He is an expert in procurement, market entry, and portfolio risk management of major food staples like wheat and rice. His core competencies center on developing customized hedging framework, analyzing regional crop production trends, and aligning corporate sourcing strategies with evolving global sustainability and environmental mandates. Welcome, Cesar. Pleasure to have you, sir.
Thank you very much, Deepak. Thank you for having me again. And it's amazing. We spoke in January where we were talking about the Black Sea crisis as being the only geopolitical or the major geopolitical flashpoint. 6 months later, we've got another one. So please don't be cautious when you invite me at the end of the year. I don't want something else to happen in the next 6 months.
No, we will be inviting you in December, and I hope Taiwan and China doesn't erupt. That is a third possibility. God willing, it shouldn't happen, but yes. So now actually straight away the question to you, what customized hedging framework are proving most effective in defending margins against the current extreme price volatility, especially in staples?
Well, I think it's a very topical question, and it's not an easy one to answer because it's something. Hedging to me feels like it's something which has started falling by the wayside. I would say 10, 15, 20 years ago when I started my career, hedging and a buyer making hedges and a supplier making hedges was something which was taught as sort of the basics, and you went through the various markets and the various tools. It feels to me that over the last years, hedging has become more a buying decision. So more and more often, the decision to hedge is made when the decision to either buy or sell the physical commodity is made. This is a challenge given that in this period where we sort of shifted to procurement becoming the preferred methodology for hedging, we've seen major spikes in price and major bear markets. We saw the food price spikes in the 2000s. We've seen the pandemic. We've seen the Black Sea conflict. We've seen recently the conflict in the Gulf, climate, derived disruptions. And we end up in a situation where more and more hedging is made by procurement, but with these amount of volatile price movements, there is a significant risk that the procurement decision is made at the wrong time, or it's made more as a trading decision than it is a hedging decision, with all the potential P&L and profitability concepts for the company. Traditionally, when people spoke about hedging, I think they focused primarily on the futures markets. I think today's markets need a much broader perspective. I think all the speakers earlier today, have sort of touched on the same concepts. Companies are exposed to futures prices, to basis movements, to freight costs, to origin premiums, to currency fluctuations, financing cost, counterparty risk, increased geopolitical risk. I think to me, one of the biggest lessons of the last years is that operational risk and market risk have become inseparable. You may have a very good futures hedge in place, but if your vessel cannot load, if a port is closed, if a railway corridor is disrupted, or if sanctions are introduced, or if a tariff is put in place, eventually your P&L can be very, very different from what was expected. We saw this in the Black Sea crisis. I lived through that, where you realize that price risk is not necessarily your biggest risk. So today, I think the hedging frameworks that make sense are the ones that focus on protecting margins rather than just protecting price exposure. But this implies integrating multiple layers of risk management. It means looking at futures. It means options, as a cheaper or more leveraged way to hedge futures. It means looking at your basis risks. Look at the basis risk, not so much on wheat, but on soybeans and corn in South America over the last 3 to 5 years versus historics. You have almost as much volatility in your basis as what you have in your flat price. Price spreads, currency exposures, operational resilience, all have to form part of a unified framework. And a good hedging strategy today has to incorporate scenario planning. What happens if export corridor closes? Mark was just saying, about we weren't expecting Hormuz and it happened. Well, what could happen next? The Straits of Malaga, Cape of Good Hope, Panama Canal. You have to scenario play. You have to consider what happens if production fails in key production zones. It's only 14 years ago that the US corn crop was decimated in a 100-year drought. Scenario playing and planning for the worst case, is going to become more and more important, and the companies that are going to be doing this are likely going to be more successful than the others. One thing that has changed, and I think this is also pushed buyers and traders and suppliers to a more price fixing hedging approach rather than a traditional hedging approach, or using the sale or the purchase of their commodity as the hedging tool. is the amount of data that we've been flooded with. Over the last 20 years, over the last 15 years, we have enormous amounts of weather data, satellite imagery, freight data, trade flow analysis, social media feeds, geopolitical intelligence, endless reports, and endless market commentaries. Now, this creates enormous opportunity for hedging, right? It should allow you to make better decisions. But the reality is that it brings increased complexity. How do you choose the right information? How do you process this data? How do you synthesize this data? And this is where I think AI is going to make a real positive contribution, where AI, I think, in the future will be increasingly, or should be increasingly, incorporated into commodity risk management. Not because it's going to replace experience or judgment, not at all. It's still going to be the human, the risk manager, the trader, the CEO, the board that will make the judgment call. But what AI is going to allow us to do is to create models that try to encapsulate all this data, all this information into tools that we can use. If there are 1,000 feeds on 50 social media platforms in the run-up to an event, can you have a tool that is scraping or analyzing or looking for trends and creates a probability factor? And that then can be used by a risk manager within a hedging proposal. These are the kind of things that I think AI would bring to hedging and to allowing companies to deal with, managing this growing uncertainty of disruption and inability to really predict the next day. Let's not even talk the next hour. There's no single solution that fits every organization. This I've realized. Flour mills, food manufacturers, governments, they all need different approaches. The goal, I think, is not to predict markets perfectly. I think that we forget that, and no one can predict that. I think the goal now is really to create discipline frameworks that protect margins. I think protecting margin is the number one, that preserve flexibility and allow companies to, perform both in stable environments and environments of extreme volatility.
Perfect. So, sir,
I
please.
will maybe just make one comment, Deepak. Sorry.
Sure.
I think I just want to relate to Hesham, where we were talking about hedging, because ultimately, when you talk about hedging, you're talking about price. Just an important reflection. In 2006, in June, Matif wheat was 156 euros, which was $195. Matif wheat today is 204 euros, which is $236, which is 21% increase in 20 years, where the compound inflation in Europe has been 55%. Sometimes what we need to remember is that our commodities, our food commodities, are cheap in real terms. And sometimes, the best hedge, and this goes a little bit against what I said in the run-up to this, but when you have an inflationary world and everything is getting more expensive, but the core underlying commodity in real terms is getting cheaper, well, sometimes it's just a question of being long this commodity.
Very, very, very pertinent and important point. Thank you for doing that. Now, I will like to draw your attention that, we are also looking at so much of talks before the war on environment as well. And Europe has been on the forefront of putting environmental regulations. That also lead to, in current scenario, a lot of friction. So where is the greatest friction occurring between, say, aggressive global sustainability mandates and the immediate need for ensuring affordable food, which according to you and me, both is undervalued or underpriced?
Well, look, again, it's an interesting question. And it's not an easy one to answer. It's like hedging. You know, if there was a perfect tool for hedging, obviously everyone would do it. So if there was a golden way to deal with sustainability, well, we would have done it already. If I can make a statement, I think the greatest friction arises when long-term sustainability and sustainability objectives encounter short-term affordability and food security realities. So it's, you know, this is where you get the friction. You understand that you need long-term sustainability, but on the short term, you have, you know, affordability and food security issues. Look, I think, as you said, I think there is broad agreement across the whole industry on the direction of the path, the direction we must travel. You know, sustainability, traceability, lower carbon intensity, environmental stewardship, responsible sourcing, all of this are necessary objectives. You know, we need it. So there's no debate. And I think very few people will argue otherwise. The challenge lies in the speed, the complexity, and then maybe most importantly, the cost of implementation and who has to pay for it, right? You know, across Europe, we're seeing the introduction of very ambitious regulatory frameworks, whether it's the EU deforestation regulation, whether it's the evolving traceability requirements, the carbon reporting obligations, the regenerative agricultural initiatives, or the renewable, you know, energy targets embedded within RED 3. You know, all of these policies are designed to drive positive long-term effects. There's no debate. However, they bring additional costs. They bring more reporting requirements. They bring segregation challenges in a market which, you know, very often does not pay you for segregation, certification, and certification expenses. And it brings additional operational complexity in a supply chain that is dealing with all these other issues, with geopolitical uncertainty, COVID, and everything else. So, you know, we have to say that for many companies, I would think that compliance and, you know, compliance to these new norms is no longer just a sustainability issue. It's now really become a procurement, logistics, you know, and risk management issue as well. Now, I think the greatest friction, the greatest challenge appears when these additional costs, because these are all additional costs, intersect with consumer and with importing countries that are very sensitive to food prices. You know, for many countries across Africa, Middle East, parts of Asia, you know, food availability and food security, as we've discussed with Hesham, remain, you know, the greatest overriding priorities. You know, a government importing food or wheat for food security may support sustainability initiatives, of course, but it must also ensure that the bread that is being produced for the hungry people is affordable. So this creates the challenge then for, you know, and a balancing act for everyone along the chain, for governments, for traders, for processors, for food manufacturers, for retailers. And it brings the bigger question, who must pay for this? Because I think that's really the big question. You know, farmers are being asked to invest in new production practices, sustainable practices. Supply chains are being asked to invest in traceability systems. Traders are being asked to, you know, manage increasingly complex compliance requirements. And at the same time, the consumer is generally unwilling or unable to significantly carry these costs. So it has to be borne by someone along the chain, and they can often be, you know, not passed down. But, you know, I think if the question is to choose between sustainability and affordability, I think that would be a false question. That would be the wrong statement of this problem. We shouldn't look at from that lens. The real challenge is designing these transition pathways as we transit to this sort of new environment that allow these sustainability improvements to take place, without undermining food security, competitiveness, or affordability. And this comes back to technology, and this is where I think this rapid expansion of both AI, technology, blockchain are all elements which can help speed up and cheapen this process. It requires investment. It requires innovation, which goes together with technology, but we need to create incentives for this innovation, and we need realistic implementation timelines. You can't say in 5 years all cars must have X amount of ethanol. That just doesn't make any sense. You can either say that in 100 years we should get to the targets, but you need to have reasonable timelines. And it also needs to take into account that different regions in the world are starting from different starting lines. And I think that's where a global view becomes very, very complicated. Countries which are still urbanizing, it's very difficult to impose the same requirements to India, which still has a very rapid urbanization, as you would impose to a Singapore, which is fully urbanized. So you need to put different requirements for different states of development. I mean, going forward, the winners, because there's going to be winners, because as we get further down the line, there will be a reward, be it economic, be it the consumer, be it some kind of regulatory reward for the winners, will be those that are able to demonstrate sustainability while improving efficiency. Very tough to get there today, but it'll be those companies that can, incorporate everything we've discussed, can bring in the technology, can bring in the innovation, and can make sustainability, a real part of their business, not something that they say they need to achieve. It's not an ESG or something to show to your banks, but something which gets incorporated into the DNA. The objective should be sustainability that strengthens the resilience, the productivity, and the affordability of the food system. That should really be the incentive. Ultimately, a sustainable food system that customers or consumers cannot afford is in itself not sustainable. So the ultimate sustainability of sustainability is that the consumer can sustain the sustainable system. So if nobody can afford it, well, the whole system collapses. But an affordable food system that ignores environmental realities is not sustainable in itself. It will not propagate. It will not continue. So the challenge really is to bring it together, is to make sure that the food system allows for environmental sustainability and that the consumer can sustain the sustainability. That should be the target. How to get there? Well, we're all going to live through it. We're certainly going to have the policymakers making the policies. We're certainly going to have civil society and business pushing back against the policies. And what we need to do is we need to make sure that we incorporate this increasingly into our business practices. If we all believe that sustainability for us, for the planet, for our children, for the future is key, well, then I guess we've got to walk the walk and talk the talk.
Perfect. Thanks a lot, Cesar. It was a pleasure interacting with you. Thanks a lot for talking so passionately about sustainability and making it very clearly understood that Sustainability needs to be affordable, and without sustainability, things cannot be affordable in long run. Thank you. Thanks a lot.
Thank you, Deepak.
So now we go to our next speaker, and we are having Vivian Iruania. She is seasoned agriculture price reporter, serving as a senior price reporter at S&P Global Energy in London. She specializes in the price discovery, benchmark creation, and market analysis of grains, mainly wheat, across EMEA region. Her deep expertise lies in maintaining real-time engagement with physical trading networks to deliver transparent, high-integrity market data amidst supply chain disruptions and shifting trade barriers. Over to you, Vivian. Thank you. Thanks a lot for joining.
Hi, Deepak. Thank you very much for setting up this session. I will share my screen.
Please, please.
Okay.
Yep, you have to just make it full screen, that's all.
Yeah.
It's on about, yeah, perfect.
Okay.
All
So
yours.
today I'll be talking about the wheat prices and outlook in the EMEA region. Something to note is that currently, due to market volatility, a lot of prices have increased in different commodities, including Platts dated Brent, which is the benchmark for oil, but also for gas, shipping, metals, fertilizer, and also agriculture as well. So globally, Platts publishes different prices for grains and oil seeds, either wheat, corn, feed, protein in the Middle East, and several other prices as well globally. Touching on specifically on what is happening to the wheat market, the Black Sea wheat market is currently peaking to May 2025 highs, largely to the fact that the ruble is very strong, and also there are currently poor and negative margins for a lot of exporters. The prices have reached May 2025 and have stayed sort of in that range pretty much since early March. And the ruble has reached January 2023 lows. If you see at the middle of the graph where we had the US, Iran, and Israel war, prices pretty much spiked and has remained high since then. The last time this marketing season when prices were high were maybe at the start of the season, whereby the planting was, the harvesting was sort of delayed, but the prices are much more elevated currently. So what does this mean for the destination side? On the destination side, we have Turkey, we have Egypt, but other countries like Morocco, Tunisia, they're all forecasted to sort of import less wheat due to a much better local production. Platts publishes the milling wheat marker, which is a benchmark for wheat, and then several prices on a CIF basis, like the CIF Marmara into Turkey, and also the CIF Ismed basis Egypt 12.5. So currently, the freight prices have somewhat retracted to the pre-war levels when the Iran war started. This is mainly due to the fact that demand is currently low. A lot of buyers are waiting for the marketing season and the marketing crop to begin. So moving on to Ukraine, Ukraine also has its own war with Russia, and which has sort of exacerbated what is happening internally alongside what's already happening with the Middle Eastern war as well. So Ukraine sort of has additional wartime pressures like logistical costs, labor shortages, and ongoing security risks. This chart here sort of describes how the wheat and corn market sort of traded near parity due to the demand trend being sort of like diverging. The corn market was mainly due to the fact that Turkey started buying a little bit more, but now has somewhat like stopped buying. Whereas for wheat, Egypt has contracted a lot of Ukrainian wheat, but at the same time, demand is overall low. You could listen more to like Platts podcasts, where we're describing more what is happening in the wheat market overall, Black Sea and globally as well. So what does this mean for the wheat market in terms of the bull, bearish, and also swing factors? Definitely on the bull side, something to watch out for is the weather. The planting risk of the weather for the winter. I'd say the weak farmer sellings and also negative margins for exporters and any logistical strikes and challenges as well. On the bearish side, buyers adopting any wait and see approaches, the high local harvest forecast and low import needs, and also the fact that there is likely going to be a heavy competition of wheat and large carry-in stocks as well. For example, Ukraine is about to have a carry-out stocks of 4.7 roughly million metric ton to the next marketing year. So that is a lot of supply from Ukraine that you would have to sell to destination markets. On the swing side, you have the P stocks, you have exchange rates, and also anything that really China really does drive in the market prices. So that is everything from me. Thank you, Deepak.
Pretty sharp presentation. Thanks a lot, Vivian. It's really very informative, and I would say, like, a short capsule which give us complete insight. And but at the same time, I have one very specific question. According to you, how is the geopolitics impacting the wheat trade in EMEA? We have seen that geopolitics is being talked about by all previous speakers. I didn't wanted to let you go without you talking about geopolitics, irrespective of whether you like Trump or you don't.
Yeah. Yeah, so I'd say the war in the Middle East, but also the war in Ukraine and Russia has definitely defined the last few months and the last few years really in the wheat trade in EMEA and also globally. But say something to notice is that despite the war, you have a lot of countries that are really dependent on the two biggest exporters of wheat, Russia and Ukraine, having to take into account insurance risk, war risks, freight prices going up or down. Aside from Egypt, which Hisham has dived in really well, you have Saudi Arabia, Algeria, Jordan, Tunisia that really have to sort of rely on several months of wheat stockpiles and issuing tenders and buying from the Black Sea for food security. And when the war with Iran intensified, those same risks were also there, including also devaluation of currencies like the Egyptian pound, increases in the diesel and fertilizer costs as well. So I'd say a lot of these countries, despite, the geopolitical wars, have to rely on sort of like the biggest exporters of wheat. For globally, something to monitor, I'd say, is definitely Australia. Platts assesses both APW and ASW wheat, which has peaked to 2-year high. Something that the traders are monitoring is rainfalls, which recently have boosted sort of the new crop prospects and have sort of encouraged some old crop sales in the region. But for the El Nino, which is likely to occur, there are risks perhaps on the East Coast during Q3, Q4. And on top of that, we have again the fertilizer costs that sort of have increased due to the war with Iran. So all of this is really going to impact what is going to happen in Ukraine, in Australia. And our analysts are forecasting a massive drop of production in Australia from 36 million metric ton to 28 million metric ton. So the geopolitical situation is affecting pretty much everyone. We have some countries that are dependent on the wheat still, and we always stay dependent. Then you have other countries like Australia would have to cut down on its production likely.
Perfect. Thanks a lot, Vivian. Yes, Australia is a challenge for everyone because of less sowing, and at the same time, US because of the weather which they are facing, and upcoming El Nino is going to be impacting both China and India, two of the largest producer of wheat. So we are having pretty interesting and challenging time for our wheat and rice basket going forward. Thanks a lot, Vivian. It was a pleasure having you for this
Thank you
session.
so much.
Perfect. So now we move on to our next speaker, and we have Dr. Rory Deverell, who is a premier risk management consultant and business owner of Black Silo Commodity Consulting, having previously led agriculture strategy at StoneX. We all know StoneX and the great content they create on agriculture commodities and energy. Holding a PhD in agriculture risk, he possesses over 15 years of experience designing advanced hedging options and future strategies for global corporations, grain market participants, and intermediaries. His expertise lies in derivative investment, modeling extreme price volatilities, and safeguarding corporate margins across international wheat and corn value chain. Welcome, Rory. Pleasure to have you, sir.
Hi, Deepak. How are you? That's a very flattering introduction. Thank you.
Because of time, actually, I was able to talk very little. Otherwise, I could have taken 10 minutes just to describe you.
No, my wife and I have different descriptions.
Yeah, you have been doing great work, and congratulations for that. And that brings me to my first question. With your deep background in agriculture risk, how do you model for the extreme price volatility we are seeing today? And there are many reasons for this volatility, but actually, any trader, any intermediary would like to find that silver bullet.
Yeah, like I like the question. I suppose when I thought about the question, I was thinking you really need to think about time and space and commodity. So what commodity? And I'll give you, I suppose, a few examples. Like one is, we've seen extreme volatility in Kansas hard red winter wheat futures. And that had a very obvious trigger in terms of the spring weather conditions that was specific to a very specific geography, which was Western Kansas. And the market reacted very aggressively to that. Now, part of our role in the ecosystem is with the Friars reports is to collect cash market data. Now, as I was watching Kansas going up eventually by $30 a ton or more, we were marking Russian and Ukrainian prices still in the high 230s, low 240s, more or less throughout that whole period. So where you had this extreme volatility in US wheat futures, which eventually pushed up US wheat prices, you saw a lack of volatility or almost no volatility over on the other side of the Atlantic in the Black Sea. Then you've got extreme volatility again in the urea market and the fuel market. And if you were to model historically the relationship between wheat prices and urea and fuel prices, you'd look at today's wheat or fuel prices and input costs, variable input costs, and you'd say wheat is undervalued probably by $50 or $60 a ton. So again, it's another situation where you've got this extreme volatility over here in a related market, but the other side of that coin doesn't seem to be too interested in following it at this point. So it makes modeling commodity prices challenging because the old relationships are breaking down. Another one is, you used to have a lovely, tidy relationship between your ending stocks, for example, of wheat in the European Union and the value of wheat in the European Union. That if the stocks were low, the price was high, and if the stocks were high, the price was low. And that whole relationship got distorted for me for two reasons. One is obviously the Ukraine war distorted that relationship because we ended up with big stocks but high prices. And that was a timing issue with the war breaking out in March, near the end of the marketing year. And but then you've also seen this breakdown in my personal confidence, and I think a lot of people's personal confidence in statistics that are made available to us publicly. The European Union's S&Ds and production outlooks, for me, are not representative of the full truth of the actual S&Ds within Europe. The USDA's interpretation is not much better, just an opinion, but it's my opinion. And so, so it makes, modeling commodity price movements, when you put all of that together, very, very challenging. So, and I think it speaks a little bit to what one of the previous speakers was mentioning about, hedging and, the relationship between physical and futures. There's a total breakdown, so, and that's actually leads into the next question. But yeah, I don't know if that answers the question, but that was just some of my thoughts on that particular question.
No, but very pertinent. I totally agree with you. And this is where actually, lot of buyers, right, end up doing common mistakes. And I would like to know from you, what are the most common mistake according to you the gain buyers make when deploying derivative instrument during such shock risk? Sometimes these instruments are not made for such type of risk, and they deploy it because that is the only thing they know. In your view, what are those common mistakes?
Yeah, like I think today's world, the most common mistake, and it's a fair, mistake is probably not the right word, but either way, I'll use the word mistake, is that there's a default assumption that if you trade wheat futures, it will be correlated to the physical wheat that you plan to sell or you have to buy. And historically, there may have been some truth to that. Over the very, very long term, there's some truth to that. But from day to day, and sometimes even week to week, and sometimes month to month, that's not true. And that was very evident this season this season just ending. Take barley. Barley is the standout example where I know there's wheat, there's barley. You're saying, what are you doing hedging wheat or barley with wheat futures? But when you don't have a choice, you kind of default to it. And historically, it wasn't a terrible hedge, but this year it was a terrible hedge because a lot of traders anticipated a large barley crop, a lot of price pressure and persistent price pressure, and they were right for a few weeks. Barley got very cheap in July and August, and then it rose $40 a ton. Now, at the same time that the barley price went up $40 a ton, the wheat price probably went down $10 a ton. So the hedge where they would have sold the barley to the export market and even just hedged 20-25% of it, say, okay, we can't buy the barley now, let's buy some Matif. So they go and do that, and next thing they see the barley price going up, farmers are not selling, they have to pay up more. So they're losing money on that end. But they would say, if it's a hedge, if I'm losing on that side, I should be winning on this side. And that wasn't the case because they were losing on the other side as well. So you're down $20 a ton potentially on the barley, another 10 on the futures or 5. And, suddenly your whole P&L for your entire grain book can be blown up. So I think the most common mistake is to default that, when you read your literature on what is a hedge, that there's a correlation between the futures and the physical. Don't assume that's the truth. And once you learn that, you probably shift your focus away to downscaling the use of futures, being more strategic with them. And as the previous speaker mentioned, being more, are they cheap rather than is it a good hedge? And, treating it like it's an asset class diversification. You treat it like a book. I'm short wheat, short barley, so I might buy this futures, those futures, because they look undervalued, not because I expect them to be a good hedge. And then use options. Learn how to use options is really the only other path that you have to take.
Yeah, to consider your point, I would say oversight, not mistake. Let me correct myself.
Yeah, mistake's a bit harsh.
And no. According to you, what are the specific risk matrices are most critical for demystifying complex future market for physical grain participants?
Yeah. Like I was thinking about that question as well, and if you're gonna, I've saxophone back there, and now I'm awful. I'm awfully you wouldn't want to listen to anything I play. But I was thinking, with that thing, as bad as I am, if you had somebody that read 1,000 books on how to play the saxophone, I'd still be better than them. And that's only because I practice a little bit, and that's what makes me less bad. So hedging and risk management and is kind of the same. You could read 1,000 books on hedging and risk management, but at the end of the day, you won't substitute actually pulling the trigger on trades, actually seeing a statement come at you with a P&L on it, that you're up 10 grand or down 5 grand or whatever the number is, that the money flows in, the money flows out, that you cannot substitute for that. So, and the other thing I've noticed, because I'm in a very privileged position to be able to watch how different traders approach managing risk. And some of them are quite rigid, and I bought physical, so I'm selling futures, or I sold physical, so I'm buying futures, and that's the system. I think that's a very flawed system in today's world. But the ones that I always get a sense are the most attuned to the market and strongest in their opinions are the ones that are constantly dabbling. You know, they're constantly buying these futures because they think it's undervalued, and as soon as they do that, they bought this position, they're looking for something expensive to sell. Okay, so they're constantly, and even if they're, like, I know some flour millers that trade soybeans, and that's just then because sometimes, you know, it allows them to connect dots that if they were completely myopic, just trading wheat all the time, they could miss something really important. So it serves two purposes. You know, this constant touch of different commodity assets in the futures and options space is it keeps them trained, warmed up, keeps them thinking, and allows them to be very attuned to their own physical book if they're a buyer. You know, I'm making this purchasing decision, the physical, because of this this knowledge that has filled into their brain through osmosis just by touching the market. And the beauty of futures is that you can do one lot here, another lot there. You know, you don't have to trade thousands of lots, like one lot, one contract, and just making the rational decision, why did I buy it? You know, that you just need to do one contract to get the value out of it and deploy that then in your procurement strategies. So that'd be my, you learn by doing.
Perfect, Dr. Rory. It's really a privilege to have such a practical insight from you. And I couldn't agree more with you. Like, you know, I generally track every possible commodities in agriculture sector, right? And that gives you a lot of perspective because, you know, sometimes the hidden trends, right, become visible. Actually, when you are myopic just in a couple of commodities, you are not able to see those trends, which you are able to see when you are having a broader canvas. And today's technology, the AI, which are driven by agents, is able to do all the hard work. Otherwise, the human brain is not capable of doing in 24 hours, getting the data, creating the charts, putting it in front of you in form of insight, where then the human intelligence can take over. Thanks a lot, Dr. Rory. It was a pleasure having you. And maybe next time we'll also have a session of saxophone from you as an entertainment for CWW.
I want that, trust me. No, I'll stick with the commodities.
Looking forward. Thank you. Thanks a lot. So now we move on to our next cheers and next awesome speaker. So we have in-house Scott Welcome, and we would like to welcome him. He's a senior procurement and risk executive who has over 30 years of experience in the grain and oilseed industry, literally working as director of grain risk management and sourcing at Good Milk Group, Europe's largest milling entity. In his career, he has overseen raw material procurement and hedging activities for both multinational trading houses as well as food processing operations. His expertise lies in coordinating massive intracontinental sourcing campaigns, complex price risk books, and aligning large-scale customer demand within the current ESG environment. Welcome, sir. Pleasure to have you.
Thank you very much. Thank you.
Yeah, thanks,
Thanks
Scott. Yes, so Scott, the first question to you, with your deep background in agriculture risk, it was previous question. Having worked at the largest milling entity, how did you coordinate massive intra-continental sourcing while navigating the localized crop failures? We are seeing that the climate is creating havoc and the local crop conditions are also very important. How you are able to manage that, sir?
I guess ultimately you have to be kind of a juggler. But I would say, sort of firstly, it's never just a market problem or a price problem. It's a coordination problem. You're trying to connect farmers, origins, freight, silo, mills, customers, finance and risk management, often across different countries, different crop conditions, and different commercial cultures. So with that in mind, and to your point about crop failure, it's really just a local problem. In a large group, a poor crop in one region can very rapidly affect quality, freight flows, replacement costs, and how other countries in the group behave. So realistically, you've got to start with the visibility. You need to have a team in place that has an honest and hopefully early view on crop size, quality, what the farmer's doing, because that's obviously a big part of price movement, what local basis is doing, silo availability and customer demand. So without that, you're struggling. The second sort of part to that, I would say, is optionality. You need to have had or been looking for local alternatives, because crop failures don't generally just happen overnight. That you can see them coming with the weather and obviously your local teams reporting back to you. So you need to have a plan for alternative origins or qualities. So you need also flexible logistics and commercial relationships to be able to quickly change the origins or the quality, because you might be importing from a different country or reallocating internal stocks. I would say the third part, and is often overlooked, is governance. Coordination is not just about everybody joining the meeting and being present. There needs to be a clear decision process. Who owns the risk? Who's going to decide on what origin we take? Which customer we supply with X commodity? So you need to have had those rules and procedures in place. So when you do have these issues, you're not sort of looking at each other for advice and answers. And I think, in honesty, in my opinion, the best way it's done is with a central view, with a local execution. The local teams know their markets, they know the customers, they know the logistics. But at the central, you can have a sort of a helicopter view of the overall position, and there you can manage the risk better. And because ultimately it's not about eliminating the crop risk, you can't do that. It's basically about making sure that you mitigate that risk, and there's no major surprises coming for the executives or for the shareholders.
Perfect, Scott. In fact, Scott, you have what you're talking. It is, I would say, it sounds so good to my ears. I've coined a leadership philosophy known as HAIR, HAIR. H is for helicopter, A is for algorithm, I is for imagination, and R is for roots. Right.
Yes.
So you have a helicopter view. You use algorithm to ensure your ground team's data is controlled and presented in the right manner. You have imagination of looking through that algorithm to find what you want to achieve. And finally, you are rooted to ground. In fact, maybe I can take your case study in showing that actually what I have been talking about for past 2 years actually is giving success to General Mills. I'm saying that music to my ears. Thanks a lot. Now that brings me to the second question. How do you balance the management of complex price risk books whilst at the same time satisfying the customer demands? Customers for milling industry are very peculiar, right? They want a specific product to be exactly as it is, irrespective of where they are buying. So that creates a lot of challenges. Unlike commodity trade, wheat is a wheat. Maybe you have few parameters to play with. But the type of business you are in, customer is they are very finicky. They dump the product if they don't see the consistency. How do you manage that?
Yeah, it's a good question, and I in sort of my notes I mentioned that it is where commodity price risk becomes very real, because you have a specific customer demand, price, volume, specifications, but the inputs going into that price makeup is moving every day. So the first discipline is you've got to separate that physical commitment from the price risk. You can have a good customer contract, but still have a bad risk position because you've got futures, you've got bases, you've got FX, energy exposure, which was before the war in Ukraine was really not mentioned a lot, but it's obviously a big topic now, and now with the Middle East. So the first thing is to ask yourself what we have sold, what we've bought, what's fixed, what's on a basis, what has been hedged, and what is exposed. So again, I go back to the visibility. Then you can decide the exposures you should be covering with physical, or you use futures options, all within obviously pre-assigned limits. The second point, and this is often overlooked, and I don't want to curse too much aspersion to sales team, but the customer satisfaction does not mean just agreeing to every request at any price. It's more about being a reliable, transparent, and commercially intelligent supplier. So you're looking to protect your customer. So that can come with fixed price. You could offer him some optionality in his contracts, some flexibility in his contracts. So as I say, it's being honest, open, and building that relationship again with them. So they trust you and they know that you're there to do the best for them, as well as ensuring a resilient supply. And I think what it is that you've got to have, again, I go back to the communication, you've got to have that good communication between sales, procurement, and risk management, because there's no point sales team making sales and not expressing to the procurement or the risk what they've actually sold, and you only see that exposure afterwards. So again, that teamwork is vital. You need to have that. And so just to summarize, if you just focus on the customer, you're going to give away margin, that's for sure. And if you only focus on the margin, you become too rigid commercially. So it really is a mixture of both. But again, coming back, it's communication within the team that you build up over a long time.
Perfect, Scott. Very well articulated. Totally agree with you. Now coming to the last question, which is very important question. You operate across multiple geographies. You have operations in multiple locations. The bottlenecks of logistics are becoming wild now, right? Even not just the commodity, the price of logistics, the insurance, they have also become very volatile. In such scenario, how to take care of that? How do you think that is impacting the business operations?
Yeah, it's become more and more important. And it's not just about having the raw material, it's having the right quality in the right place at the right time, and ultimately at the right price. You've got different harvest windows, different transportation systems, even in Europe, which is quite remarkable to believe. Different storage constraints and border regulatory issues. So timing is key. We need consistent supply to your facility. But you've got to manage that around seasonal and weather factors. Obviously, you've got the big supply at harvest, and then you've got to sort of fulfill that year round until the next harvest. So that's a key one to manage. Quality segregation. So that's where your silo manager or warehouse manager or plant manager is really key. There's no point you sourcing some very good quality crop for a customer, or because you see there's a shortage of that raw material, and they mix it in with some different grade or lower grade material, then you've lost all the benefit you had. So quality segregation is vital, particularly in a milling business. Then you have your transport teams, your logistics teams. They need to work aligned. They need to know what rail is available, what trucks are available, the cost, border regulatory needs. So whilst the position may look profitable on paper, if you don't have all those parts of the supply chain, the value chain aligned, then you're going to quickly lose margin very, very quickly. And then ultimately with that is the coordination. You need, again, I keep repeating it, but it goes back to communication. You need all those departments coordinating, talking to each other to make sure that every link is aligned, and that you don't create your own bottlenecks in an already disjointed market. So yeah, it's not easy. But again, I think if you have a clear goal and you have a clear alignment amongst your teams and everybody knows their responsibilities and what they're in charge of, it makes things a bit easier. And so logistics is not just about the cheapest route, it's about the most resilient route. And that's what I think you need to work on if you're involved in a company that has multiple locations in different countries.
Perfect. Thanks a lot, Scott. It was a pleasure talking to you. And I would appreciate the great work you are doing, pretty complex in the tough times, and you are doing super awesome. Thank you for joining this session, sir.
Thanks very much for inviting me. Thank you.
Pleasure. So now we go to our next speaker. So we have got Anton Jamadiev. Apologies if I have my pronunciation was wrong. It's a very difficult name for we Indians to speak. So he is an agribusiness executive with over 10 years of experience across international agriculture trade, logistic, infrastructure, and production. He has worked in public administration, that is Parliament of Ukraine and Ministry of Agrarian Policy, international trading with CHS Incorporation, infrastructure and port operations with Mexgrain Ukraine, and leading Ukraine agriculture companies including Asatra and TAS Agro. He specializes in grain, oilseed, vegetable oils, and with specialization in Black Sea agriculture export with practical experience working with market across Europe, MENA, and Asia. Welcome, sir. It's a pleasure to have you.
Yeah, good morning, everyone. Thank you for invitation. First of all, it's a big honor for me to be here today and to speak a little bit on wheat side from Ukrainian perspective. Let's start with a broader picture. Ukraine remains one of the world's most important agriculture exporter, and we are third largest wheat producer globally. As from the beginning of the war, a total volume of production was decreased from 100 million ton in 2021 to 65 million ton per last season in 2025. So before the 2022, the biggest risk for Ukrainian wheat production was a risk of the weather, and now we have much more risks. It's ports, railway logistic, it's storage facilities, shipping corridors, vessel corridors as well, and insurance. And it become a critical parts of value chain. Another important trend is regulation. The European Union is introducing increasingly strict requirements regarding sustainability, traceability, and even 2 seasons in a row they try to implement EUDR regulation, which will close to look for a resilient territory from forest as well. So for Ukrainian exporters, this means that competitiveness is no longer determined solely by the price. It is increasingly determined by transparency and compliance. Let me also briefly explain why our company has a unique perspective on these developments. Because first of all, TAS Agro is a part of a big TAS group, diversified holding active in finance, logistics, and insurance. This ecosystem gives us access for capital, logistic infrastructure, and risk management policy. So today we cultivate around 80,000 hectares of lands, and we also own more than 2,000 wagons, which give us opportunity to deliver cargo securely in time. And more than that, we also provide new strategy and start to trade from our silos and deliver cargo from our farmers which are located around our clusters and silos to export markets. And it's evolving us from being a simple producer to becoming a service infrastructure platform connecting Ukrainian farmers with international customers. So it's a map illustrate our operating regions in central Ukraine. These regions remain among the country's most productive agriculture areas. Despite all challenges of war, production has remained remarkably resilient. And resilient is not unique to TES Agro. It reflects the resilience of the entire Ukrainian agriculture sector, despite of the big war here. So this slide highlights what actually we consider as the most important issue for Ukrainian wheat. Ukraine, as I was mentioned before, does not have a production problem. So the weather is very nice. So it's rainy, the moisture is okay, and now we have a pretty low temperature. I mean, it's around 20 degrees, maybe below. So it's kind of strange for this period of time in May for Ukraine. I mean, to compare with the last four or five seasons, but it gives us a prominent that we will have a good production volume and yield as itself. So current estimate is around 22 million. It's from 22.3 till 21.8. But probably the main issue as for now is a big ending stock. So as for now, it's around 4.6 million ton. Domestic consumption remain unchanged. I mean, up to 6 million ton for this season, and the majority of production must be exported. The challenge is ensuring the export infrastructure can move this volume efficiently, and competitively, because of the attacks for port infrastructure and for railway infrastructure, it remain pretty difficult to be in pace of export around 7-8 million ton per month as it was before the full-scale war. Now we have the pace around up to 4, maybe 4.5 million of total. I mean, not only the wheat, it is a corn, wheat, also barley, and volumes of sunflower meal and sunflower oil. But once more, so the logistic is really difficult. I mean, now it is not a question only about I mean port logistic, but railway logistic is also a challenge. If we talk about truck logistic, it is also a kind of challenge because the absence of drivers give us the situation that we are lack of trucks, as well as it is hard to find drivers. I mean, because as you probably know, a lot of men are fighting on this war. So another slide is demonstrate how Ukrainian wheat export are becoming increasingly diversified. I mean, our top demand market is Egypt, Algeria. It is hard for us to reach Asia because all those markets are occupied by Russia. And at the same time, Europe is becoming increasingly relevant. The chart on right shows monthly export pace. As I said before, it is only for wheat export. The most difficult period was from December till February. As you can see, the export pace was decreased by 2 times in this period. For sure, it was influence from the attack on port infrastructure and railway infrastructure. But another reason is, of course, the pace of corn export for this period as well. As for now, we only made 71% of export program for this year, and it is pretty low numbers. You can see the other season as well. I mean, just to compare and to understand the pace which was before. As you can see, for the last season, even for the last season in June, we completely done the program of wheat export. Taking this chance, I wanna say thanks for partner of our company is a Borrow Investor analytical agency, which helped me to provide you this analytical information. Just to leave you with 3 thoughts. First, Ukraine remains a reliable supplier to global grain market. Even we have difficulties with logistics. We have as a minimum 3 routes. So with deep ports, I mean Odessa, Chornomorsk, and Pivdenney. Also, we can use Danube ports. It's a small ports on the south of Ukraine in Odessa region, and we can deliver cargo to Constance as well, and load even handy Panamax over there. And we also have third route. It is the western border, and yeah, it's possible to deliver cargo despite of all these difficulties. And for last 4 years, we gained probably the most remarkable experience for my career, for sure. I mean, in terms of crisis management skills. So yeah, believe me, we can be very flexible and fast replying in any case. So the second point is logistic and geopolitical are now just as important as agronomy. So as I said you before, the production side is remain resilient and unchanged. So we are moving to make agronomy more efficient, but logistic and geopolitical side is pretty difficult for now. And the third thought is future of I would say food security depends on keeping trade routes open, ensuring market access, and supporting resilient agriculture supply chains. Ukraine has proven it's resilient, and now the challenge is transforming resilient into the long-term growth. I would like to thank you for the attention and look forward for your question. Thank you.
Yeah, thanks a lot, Anton. Pleasure having you, and I understand difficult situations. Wars are always a challenge for everyone, including for food safety of the world. And I believe going forward, things are going to improve. Unfortunately, we've run out of time, so I would thank you here. You have already shared your credentials, so anybody who wants to have questions on Ukraine, they can reach out to you. Wish you all the best, and looking forward to visit you in Ukraine, irrespective of the times we live in. Thank you.
Thank you, sir. Thank you.
So now we move. Yes, sure. Now we move to our next speaker, and we are having Mr. Sandeep Agrawal. He is a premier international trade executive serving as a business head for rice at Aditya Birla Global Trading, an alumnus of Indian Institute of Foreign Trade with over 20 years of experience at Phoenix Global and ITC. He commands a massive global rice portfolio spanning Asia, Africa, Middle East. His core expertise include high volume trade, navigating cross-border maritime logistics, and managing regulatory compliances across volatile staple food market. Pleasure to have you, sir. Thanks for joining.
Thank you, Mr. Deepak. Thank you for having me.
Yeah. So Sandeep ji, first question to you. How are you navigating the immense regulatory compliance hurdles and export restriction currently defined by global rice market? We are seeing some countries putting export bans, some countries in West Africa just coming out and putting import bans. So we are seeing a lot of volatility in rice market when it comes to the policy. How to get around these?
So again, if you understand rice as a commodity, it's one of the staple diets for the world. More than 50% people in the world depend on rice for the daily nourishment. So rice being so important from a food perspective is also very, very politically important. So most of the governments in countries, they have an indirect role in the either production, import, export of rice. Governments want to be involved. Governments want to ensure food security. Governments have a mandate to, in exporting countries, they have a mandate that the farmers should be paid well, but the country also needs to be competitive. In the importing countries, again, they have to ensure that the farmers are able to grow more and more, but food is again cheap for the general population. So it's a very tight rope that governments have to walk. So governments intervene from time to time. It again depends on various factors. So in exporting countries, mainly, if you look at the export map of rice, rice is exported mainly from the Asian region. So India is a very large exporter, followed by Thailand, Vietnam, Myanmar, Pakistan in Asia. And you also have countries like the United States and the South American countries which export a bit of rice. European countries do export, but it's very, very small quantities. So if you look at the exporting countries, most of them have export surplus. And they export rice year after year. So for them to ban export of rice is very, very seldom. India does that from time to time, depending on the local production, because the Indian exports is less than 20% of the local production. Whereas in a country like Thailand, it's more than 50%. So the Thai government would not ban exports ever. What an Indian government can do, keeping in view the local requirement. So you do have to face this as a trader. You have to keep anticipating depending on the local price rise in the country and what the governments are expected to do. The importing countries actually do it more often. So you have cases where rice is totally restricted in terms of who can import rice. So in a country like Malaysia, you only have one importer, which has been mandated by the government. In Philippines, it's again all quota-based. Indonesia, again, it's quota-based and the government importing from time to time. In a lot of the African countries, you have the African governments giving out quotas to very few players who can import. Now, in a country like Benin, recently, they've come out with a regulation saying not everybody would be allowed to import, and there are certain norms that have been defined, and companies which fulfill those norms to be allowed to import. So these restrictions keep coming from time to time. Now, we as a company, we have a global footprint. We are there in most origins. We are there in a lot of the destinations. We've got very, very large clients in many of these destinations. So what we try and do is we try and be on top of what's happening on the regulatory front. We have a network of people. We speak to them on a daily basis. We follow news from those countries. We look at any signs of stress that there may be in the political scenario in that country. So these things give us a fair amount of idea as to what is anticipated to happen, and we take our calls accordingly. Again, if you look at the European Union, it's a region which has a lot of regulation for imports. They are one of the most stringent regulations that you can have for rice imports anywhere in the world. They are very, very finicky about pesticides, the DNA-based testing, heavy metals, etc., which needs to be complied with. So compliance for the European market is very, very stringent. Again, what makes it very challenging in rice is that it's a very volatile commodity. So you have millions of, I would say hundreds of thousands of varieties. Most of them are consumed locally where it is grown. Some of the varieties are exported. Now, the consumer tastes and preferences are very different in rice. So you could have a neighboring country. Let's say, take the example of Benin and Nigeria. Benin is a white rice eating country. Nigeria, which is just 50 kilometers or 100 kilometers away, is a power eating country. It's defined by culture. It's defined by past, I would say, availability. So it's very difficult to change the food habits. So we as traders have to be very, very cognizant of the fact as to what type of rice is consumed in a particular country, what kind of taste and preferences people like, and we have to trade accordingly. So these become kind of restrictions for us in how we trade rice. It's not a commodity that you can trade, like say like your wheat or corn, which is very, very homogeneous. You could load a vessel, take it afloat and sell it to any country which provides a better price or a better value to you. In rice, it does not happen that way. It's bagged, it's packed in most of the time in the importer's bag marks, and you can only sell to a particular country which would accept that rice. So it makes it difficult, but being in the market for so long, you exactly understand what is required in each country and you trade accordingly. So one has to be very, very, I would say, very, very careful about what you load for a particular country, what grade do you sell to the client, because a lot of times the clients don't even know. They just tell you that I want so-and-so quantity and at so-and-so price, and you can go ahead and sell a wrong quality, and then you get stuck with problems at the destination. So it's experience. It's also the benefit of managing a large book that we have assets on the ground by which we kind of identify and trade accordingly.
Perfect. Sandeep, I totally agree. Rice is one commodity where artificial intelligence doesn't work. You have to have human intelligence. So many parameters, and then actually also, as you rightly said, like it is consumed by a huge number of people, and in those countries it is more than staple. Like they don't eat anything else, right? It is it becomes a requirement. Because you have answered a lot of my questions already, I would do a little bit of a tangent here. Africa has been showing a little bit of uncertainty of late, right? So, and you operate in Africa. So when we talk about West Africa, right, we are seeing that suddenly there is a lot of countries trying to either restrict the import of rice, putting a tariff barriers as well as non-tariff barriers. Do you see that actually there is some specific reason behind that, or they just really what they say that they want to push for self-sufficiency as a reason for doing that?
I think self-sufficiency is something that is in the minds of the government. So most of these African countries are importing from anywhere between 300,000 tons to 2 million tons of rice. Now it's a huge drain on the forex reserves of those countries. Now these countries are poor, and for them to spend $1 billion or more on rice imports is something which is not desirable. Now Nigeria tried it 7-8 years ago. They banned the import of rice. Of course, the borders were porous through Benin and Niger, but through which rice kept coming in. But that rice was expensive. And when inflation hit very high in Nigeria, then the people did not have a choice, and they went back to the farms. So the rice production in Nigeria increased dramatically. Once the paddy production increased, you had the mills coming in. People invested in processing mills, and as a result, the availability of rice increased dramatically. Now, this model is actually something that can be replicated by the other African countries. It is possible. They have enough land, they have weather, they have water, they have all the natural resources by which they can grow, move food. It's only a question of supporting agriculture, adopting agricultural best practices, and supporting the farmers in the agri inputs, etc., that they need. Just like what the Indian government did 30-40 years ago by coming out with a model where farmers are supported not just by import duties on essentials, but also by way of cheap fertilizer and seeds. The African governments are now beginning to do that. And you can totally understand it comes from a mindset where self-sufficiency becomes important. We've seen rice prices being very volatile. And we've seen a case in 2008 where prices hit $1,000. We've seen it during COVID where availability became a big issue because logistics were challenged. So no government can afford to play with food, and food security is one of the most paramount duties of a government. So I think this is happening more and more, and we expect the local regulation in terms of people adding value on the ground, akin to be given import licenses, is going to intensify in a lot of these countries. So there would be regulations where if you don't invest in the local production or manufacturing, you will not be given an import license to import. It's already happening. We can see that, and more countries are going to adopt it from Nigeria. And this is, I think, the future. So one, as a trader, we need to again look at how do we add value in the supply chain. It's not going to be the days of buying pure FOB, selling CNF, making a spread. Those days are being numbered now. Supply chain interventions, supply chain investments are going to become very important, not just from a competitive point of view, but also from a regulatory point of view where governments are going to enforce that in the coming future.
Perfect. So my last question to you is that actually, see, when you are doing business across multiple geographies, right? Of late, the logistic is becoming one of the big challenge, right? And the geographies you work with, right, they are having a lot of choke points already there. In fact, you live in a place where actually is next to the choke point. So, but we are seeing that actually of late, Iran is talking about even like, putting pressure on the Red Sea also, like, we are having Strait of Hormuz being closed. Middle East has been one market. Africa, again, you have to reroute in case something goes wrong in the Red Sea, which happened like, I think a year back. How do you see logistic? Because, of late, if you see when the prices were, though it's still they are low, rice prices were like, at the bottom. Sometimes the only margins for the logistic, if you are able to get a good logistic deal, you'll be profitable. Otherwise, you won't be profitable because actually the commodity was not giving you price. In such scenario, actually, how do you manage the logistic part of the game?
See, logistics is extremely important in rice. So, I mean, it's a very logistically heavy, logistically driven commodity. Now, when we charter a vessel from, say, Asia to take it to West Africa, we charter a vessel for 90 to 100 days. Now, which is unheard of in most other commodities because loading is extremely slow, 30 to 40 days of voyage, and then discharge is extremely slow. So the discharge rates in Africa are 1,500 to 2,000 tons a day. So the vessel gets employed for a very long time. Now, during a crisis and during times when the freight market is very volatile, you would typically see owners moving away from rice. Now, rice is something where once you lock in your vessel, for a good 3 to 4 months. Now, in a rising market, owners don't like that. They want shorter voyages where they can finish a voyage, take advantage of a moving market, and then lock in the next voyage at a higher freight. But in rice, if you do that in a rising market, you lock in your freight for the next 3 to 4 months, and you kind of miss that upside. So during the 2022-23 crisis during COVID, when logistic costs have gone up dramatically, it was very difficult to charter a vessel for rice. So we have to be very, very careful about what we sell and how do we manage a freight risk. Of course, you have the Baltic Dry Index where you can hedge your paper, but again, there is no direct route from Asia to Africa that is traded on the BDI. You can take a mirror contract, which is, say, a Supramax contract, but then again, you have a premium or a discount which is loaded onto it because rice, again, from Asia to Africa is a backhaul business because most vessels go to West Africa and then reposition into South America to carry grains into Asia. So being a backhaul business, during moments when market is quiet, you would typically get a discount on the index. But during these high volatile times, the market would move into a huge premium. And that is something that you can't hedge. So when we see any signs of stress, a war breaking out or bunker problems or problems like COVID where you have these logistical problems, we try and cover our freight very, very quickly. We don't keep things open and we try and go to owners which are willing to give us forward freight. So it's very important to be fully covered during a time of crisis and not take very long positions on your logistics or on your logistics because it could become a nightmare and the market could suddenly dry up completely. Again, rice is a commodity which cannot be hedged. The freight on rice cannot be hedged. Container freights, of course, are spot. So we are open on all fronts. And as a trader, you would want to lock in at least 1 or 2 parameters so that you're not exposed on all the fronts. Again, not to mention the African currency situation. That becomes another problem, another challenge. During crises like these, the forex shortages in the country start showing up. And you would see a situation where the buyer is sitting with local cash, but he does not have the dollars or the euros to remit out to you. So these are challenges that do come in. Logistics become very, very important for us. And we try and ensure that we don't take very long positions on the logistics front during times of stress, and we play a short game where we would cover our positions quickly and then move on to the next contract.
But Sandeep, actually, for Aditya Birla Group, which is trading into so many commodities, that gives a leverage actually for currency at least, because in all these countries, you might be selling something, you might be also buying something. For other traders, that's not a luxury they can have, isn't it?
So wherever we have a two-way trade, it does provide a leverage. But there are a lot of countries where we only have one-way trade, either we are importing or exporting. So then it becomes a challenge to manage that risk. But then, of course, I mean, that is what our business is, and we live every day to just manage the risk that we have and make whatever money we can.
No, Sandeep, frankly, like, as an Indian, it feels so proud about like the work Aditya Birla Group is doing, right? I travel across the globe, and when I engage and your name crops up, right? Whether it is specialty chemicals, whether it is fertilizers, whether it is agri commodities, and that gives, as an Indian, like, a big feel-good factor that, like, there is an Indian multinational, like, which is being recognized with the respect, right? That is very important. There are a lot of players which are known, but the respect which is being commanded by Aditya Birla Group is phenomenal. Congratulations for that, and thanks a lot for joining this panel. Thank you.
Thank you so much for having me. Thank you.
Perfect. So with that, we come to end of this interesting second session today, where we talked about wheat and rice, and with focus on Europe, Middle East, and Africa. We talked about different aspects, from risks to currencies to macroeconomic situations, and at the same time also surely supply and demand of wheat and rice. Now going forward, we'll be having one more session today. So today we'll be having two awesome speakers in the evening, which is 9 a.m. New York time, where we'll be talking about wheat and rice Americas, covering North and South America. Two awesome speakers, one talking about extensively on rice, one talking about wheat. Looking forward to see you again and join us today, 6:30 p.m. India time and 9 a.m. New York time. And also for another 4 days, where we'll be discussing about pulses, oilseed, sugar, agri-tech, and logistic. I hope all these engagement has given you more insight, and that was the idea, to give you market intelligence unfiltered in a democratic way and sitting next to your screen or in front of your screen. With that, signing off, your moderator. This is Deepak Pareek. Thank you for joining and looking forward to see you again. Take care. Good day. Bye.